Hi, everybody. Welcome back to the Online Tutor, the one place that turns questions into answers. Today, we're tackling a concept. Let's get our black pen out again. A concept called trading stock. One, either it's a deficit or it is a surplus. And what is the difference between the two? So people like to confuse themselves by talking about the balance of it or the amounts in the general ledger, and then they talk about trading stock. You know, then you just get confused. So it's always easier to have one simple reference point, meaning trading stock. We're talking about trading stock deficit or trading stock surplus. So let's always go back to our primary reference. And our primary reference can always be trading stock. So either we are saying, first of all, trading stock deficit means that there is less trading stock. Okay, so I'm going to refer to trading stock as TS to make it easier. There is less trading stock on hand versus in the books. Okay, and by books, I'm talking about our general ledger or our balance sheet. Yes? Yes. Versus surplus, which is the complete opposite. So when we think of deficits, we think of lack. So it's less because our reference is always trading stock. We'll say less trading stock on hand versus in the books. Okay, surplus always means more. You have more than what you need. So we are saying more trading stock on hand versus in the books. And again, what is books? Our general ledger or our balance sheet. Does that make it simpler? Yes, no. Okay. So go back to the definition. In basic terms, when you think of deficit, you think of lack. You think of less. So we are saying less of what? Less of trading stock in your on your hands, on your shelf, in your storeroom, you know, in the company, on your premises. Less trading stock on hand versus in the books. What is reflected in our general ledger, in our balance sheet? Okay, so let's think of a few reasons as to why somebody could get, let's create a different color for this. Why somebody could get a deficit and why somebody could get a surplus. So, for example, a deficit could occur because goods are damaged. Yes? Think about it. Goods are damaged. Goods are damaged, goods have expired. What else? And of course, simple things like errors. People make errors in terms of putting numbers in our books, you know. They don't put the exact amounts in the books. So basic things like errors, things are damaged, things expire, and theft. So let's think of a practical example. So when something is in deficit, very practical example. So let's say your siblings, and we are saying there's less stock on hand versus in the books. So you told yourself that, you know what, I'm gonna buy a chocolate for myself to eat with a cold drink, and I'm gonna leave this in the fridge. Okay, so you leave your cold drink and your chocolate in the fridge. So you know you bought it. So in your books, you've got cold drink and chocolate, and you've left this in the fridge. So cold drink and chocolate are both in your books, right? But you have siblings, and your siblings go and they take a bite of your chocolate and they pour themselves a glass of cold drink. So in reality, you have less cold drink and you have less chocolate than what you know you have. So in your books, you have a full chocolate and a full cold drink that is unopened. But in reality, you only have cold drink less one glass, chocolates less three bites of chocolate, you know? So you don't have your full chocolates, but you don't have your full cold drink. So you have a deficit of cold drink, you have a deficit of chocolates. Okay? If you have a surplus, for example, let's take a random example. You have a money box, yes, that you keep at home. And you know you've put inside 50 Rand, 50 coins that amount to 50 Rand. And somebody donates into your money box without you knowing. So what you actually have in your money box is 50. What you think you have in your money box is 50 Rand. And this is what you've recorded in your books. But what you actually have is 80 Rand because somebody put inside more coins. Okay? So you have more trading stock, you have more coins on hand versus in the book. So in the book, you've only recorded your, did I say 40 Rand? 40 Rand. Let's say it was 40 Rand. In your money box, you only recorded 40 Rand. But what they donated is more than the 40 Rand. So you've got more on hand, you have more in your money box than what you've recorded in your books because you only know of the 40 Rand. Okay? And again, trading stock surplus could occur for similar reasons. So, for example, if somebody makes an error in reporting, that could be a problem. That could cause differences in your trading stock balance. What else could be a reason? So, for example, you make purchases, but you don't account for these purchases. So, yes, purchases are not accounted for. In books. So you are buying inventory, but you do not record it in your books. So there's a discrepancy between purchases and what's in your books. Okay? What is our journals? Your journals. Our journals. Okay, so what is our debit and what is our credit? So first we need to think of, is trading stock, let's grab a different color. Is trading stock deficit an income, and is trading stock surplus an income or an expense? Okay, so if we're saying we have more, surplus means more. Okay, we are most likely to call it an income. And if deficit means less, we are most likely to call it an expense. Okay, so let's go back to definition. Trading stock deficit means we have less trading stock on hand, or the amounts taken per the stock take figure versus what is in our general ledger or our books. Okay, so because what is in our books is less than what is on hand, we need to increase our trading stock. If we have a surplus, we have an income. It's almost as if we are bringing trading stock up. We are accounting for trading stock that we hadn't accounted for yet. Versus here, we are reducing trading stock. In a deficit, we are reducing trading stock because we are saying either it got stolen, so it's non-existent, it's gone. There is less trading stock than what we thought. Okay, here there is more trading stock than what we thought. So we are trying to bring trading stock up. Therefore, our journals would be trading stock deficits is an expense, so expenses are debited. So we're saying trading stock deficit expense. And then here we are saying trading stock. This is an asset. So for example, if we are taking the example of theft, we're saying because goods were stolen that we weren't aware of was stolen. We have less trading stock. We have less trading stock than what we thought we had. So the amounts in our books must come down because it was more. Yes? So now that we know that certain amounts of goods were stolen, let's say 10% of goods were stolen, we need to bring our asset balance down to what's actually there. So we always need to bring trading stock in books must always reflect what's on hand. Yes? Okay. So here we're saying we are reducing trading stock in our books to what is on hand in our stores. Yes? Okay. So if we have a deficit, an expense is always debited, we need to bring down trading stock because now we know that theft occurred because we have less trading stock on hand. We need to bring it down to what's actually on hand. So book balance must reflect what's on hand because that is the most correct amount. Versus a surplus, journals for a surplus, we would say debit, credit again. A surplus is credited because it is an income. So we want to say trading stock, surplus, which is an income, and then trading stock, which is an asset. So we are bringing trading stock up because we didn't account for it before. Yes? We are saying we sold certain trading stock or we purchased certain trading stock, but we didn't account for it in our books. So we need to bring up our trading stock balance. We need to bring up our trading stock, balance. Okay? So we're going to bring it up by the difference compared to what's on hand and what's in the books. I hope this is making a bit of sense. If it's not, please do leave your questions in the comment section below.